All right, today we are going to demystify a topic that is quite literally at the heart of every single business out there: financial management. We're going to break down what it really is, why it's so important, and why getting it right is the absolute key to success. So, let's dive in. It sounds almost too simple, but this is the most fundamental truth in business. Doesn't matter if you're a giant global corporation or the coffee shop on the corner, money is the fuel. It's the lifeblood. Without it, the whole engine just stops. And that right there is the million-dollar question, isn't it? Because just having money is not enough, not even close. The real trick, the thing that separates a company that thrives from one that just disappears, is knowing what to do with that money. How do you manage it to survive today? And more importantly, to grow tomorrow.
Which brings us to our first big idea. Getting money in the door is just chapter 1. It's only the very beginning of the story.
So this is the modern way to think about financial management. This isn't just about raising funds. That's kind of the old school view. Today, it's an active, ongoing process. It's about planning, it's about control, and it's all pointed towards one single goal: making the entire company more valuable. Okay, so how do you actually do that? Well, you can pretty much boil this entire field down to 3 fundamental decisions. Think of them as the 3 biggest questions a company's leadership team has to answer day in and day out. And here they are. First, the investment decision. Where are we going to put our money? Second, the financing decision. Where's that money going to come from in the first place? And third, the dividend decision. When we make profits, what do we do with them? Every major financial choice a company makes fits into one of these 3 buckets. Let's break them down. So the investment decision is all about how you use your money. This covers the huge long-term bets, what the experts call capital budgeting, like say building a brand new factory. But it's also about managing the short-term stuff, the day-to-day operations, making sure you have enough cash on hand to pay the bills. That's all about liquidity.
Okay, next up is the financing decision. So, you've decided you want to build that factory. Great. How are you going to pay for it? You can either borrow the money, that's debt, or you can use money from the owners and other investors, that's equity. The real art here is finding the perfect balance between the two, what's called the capital structure, so you can fund your growth without getting into too much trouble. And finally, let's say things are going well and you're actually making a profit. Now you've got the dividend decision. Do you hand that cash back to the shareholders as a dividend? Or do you keep it in the company, what's called retained earnings, to pour back into the business for even more growth? It's that classic tug of war between a reward right now versus a potentially bigger reward later. Now, you'd think all these decisions would be guided by one simple goal: make as much profit as possible, right? Well, for decades, that's what everyone thought. But it turns out that might actually be the wrong target to aim for. And this really frames the whole debate. On one side, you have profit maximization, just chasing that big number on the bottom line. But on the other, you have something called wealth maximization, which is a much more sophisticated idea about increasing the company's total long-term value for its owners. So what's actually wrong with just chasing profit? Well, for starters, it has some pretty big flaws. And the first one is that it completely ignores when you get paid. This table just lays it out perfectly. Look, if you only glance at the total profit, both Project A and Project B look identical. They both make $30,000. Easy, right? But hold on. Look at year 1. Project B gives you a massive chunk of that cash right away. And we all know that $1 today is worth more than $1 tomorrow because you can put it to work sooner. Project B is clearly the better choice, but a simple profit goal totally misses that nuance. And the second flaw? Well, it might be even bigger. Chasing profit, and only profit, means you completely ignore a huge factor: risk. Check this out. Once again, if you just look at the average profit, they look exactly the same, $10,000 each. But look what happens during a recession. Project A is steady. It still makes good money. Project B? It gets completely wiped out. It goes to zero. Sure, it does great in a boom, but it's a total roller coaster. The average profit might be the same, but the quality of the profit from Project A is way, way higher because it's so much safer. So if just chasing profit is a flawed strategy, what's the alternative? This brings us to a much smarter and, in the long run, wealthier goal. And that superior goal is wealth maximization. The key phrase here is present value. Basically, it answers the question, what are all the future profits a company might make actually worth to me, right here, in today's money? It's a powerful idea because it automatically adjusts for both of the problems we just talked about:
Timing, because money sooner is better, and risk, because a sure thing is worth more than a gamble. So at the end of the day, wealth maximization just works better. It's precise, it gets that a dollar today is better than a dollar tomorrow, it pays attention to risk, and it pushes managers to build real, sustainable, long-term value, not just chase a quick, short-term profit. And that brings us to the final concept that really ties everything we've talked about together. This is the fundamental principle of, well, all of finance, really.
When you strip everything else away, every single financial decision, investing, financing, dividends, all of it is a balancing act. It's a constant trade-off between two powerful opposing forces.
And this diagram just captures it all perfectly. You've got risk on one side and return on the other, and you see our three big decisions, investment, financing, and dividends, are all about striking the right balance between the two. Want to get a higher potential return? You almost always have to take on more risk. The entire art of financial management is finding that sweet spot, that perfect balance, to hit that ultimate goal, maximizing the company's value. Okay, so let's do a super quick recap. Financial management boils down to those three key decisions: where to invest, how to pay for it, and what to do with the profits. We learn that just chasing profit is a bad idea because it ignores timing and risk. Instead, the real goal is wealth maximization, building long-term value. And every single choice you make is a constant balancing act between risk and return. Which leaves us with one final and much bigger question to think about. If a company's main job is to maximize wealth for its owners, what about everyone else? What does it owe to its employees, its customers, and to society as a whole? Now that is a debate that goes way beyond the numbers on a spreadsheet.